Good morning and Jai Hind. In today's video, I am going to start the new topic, that is accounting ratio. So, what is ratio? Ratio is simply one number expressed in terms of another. We have already learnt ratio from from class 6th. So, it is quite obvious what is ratio. Whenever our number divided by the other number, the relationship between these two numbers would be termed as ratio. Now, ratio may be expressed in the following four ways. The first one is in proportion, or we may say pure ratio or simple ratio. It is expressed by simple division of one number by another. Here we have to consider 1 as a denominator, and whatever ratio that comes, that means whatever relationship between the numerator and denominator, would be known as pure ratio or simple ratio. Next one is rate or so many times. That means how many times one number or one figure is. That means what is the relation in terms of rate in comparison to another figure. Yes, it is given in example here that if a credit sale is 2 lakhs and the trade receivable is 40,000, then trade receivable turn ratio would be 2 lakhs upon 40,000. It comes as 5, and it is represented in terms of times. That means the answer would be 5 times. That means the credit sale is 5 times in comparison to the trade receivables. The third way to represent the ratio is percentage. That means the figures are related or expressed in hundredth. Suppose a firm capital is 10 lakhs and its profit is 2 lakhs. So the ratio of profit to capital would become in percentage by dividing 2 lakhs by 10 lakh, and it gives 20%. Here the ratio is represented in percentage. And the fourth way that is used to represent the relationship between two numbers is fraction. So, as you can see, the net profit is 1/5 of the capital. Here there is no restriction regarding the value of numerator and denominator as in case of pure ratio, where the value of denominator should always be 1. Now let us see the cross-sectional and time series analysis. See, the ratio analysis helps in comparing the performance of a firm either with the other firms in the same industry or with itself. So whenever a firm involves in the comparison of ratio with some other firms of the same industry, that means some other firms which are engaged in a similar kind of business, then that kind of analysis or comparison would be termed as cross-sectional analysis. While when a firm involves in a comparison with its own past records or past ratios, then that kind of comparison would be known as time series analysis. These both kind of analysis helps in analyzing the current situation, current performance of the firm, whether it is improving or deteriorating, or the performance is constant. Everything could be determined using these two kind of analysis. So, calculation of any kind of ratio is not enough for determining the performance of a company. It is needed to be compared with something, some standard or benchmarks. So, the benchmarks would be like past ratio. That means a company can compare its performance by comparing the present ratio with the past ratio of itself only, as we have seen in time series analysis. Next kind of benchmark that a company may use is ratio of similar firms or industry average. As we have seen in cross-sectional analysis, that the ratios of other firms of who are engaged in similar kind of business, that means they are those who are in same industry, with those industries a firm can compare its ratio. That means the ratio of other firms would be considered as a benchmark for one's company. And the third one is rule of thumb. That means some well proven conventions have been evolved over a period of time, as we can consider the case of current ratio. The current ratio should be 2:1. This would be the standard or benchmark, or we may say rule of thumb. And this means the current asset should be twice of the current liabilities. This would be the standard one, which is favorable, or we may say the satisfactory ratio appears for the firm. With this, I am going to end my video. Thank you.